Thanks for joining me at the News Forum, where all voices matter. This is Strictly Money, and I'm your host, Saijal Patel. If you are one of the millions of Canadians itching to travel this summer, you know by now that you need to plan extra carefully and pack a lot more patience. You'll also want to pick the right travel insurance. With flight cancellations and baggage delays, today's reality, not being properly protected can cost you thousands of dollars out of pocket. Joining me now with his advice on what you need to know before buying travel insurance is Matt Hans. He's Business Director of Insurance at Ratehub.ca. Matt, great to have you on.
Great to be here.
You know, it wasn't that long ago, I feel like travel insurance was, highly recommended, but not necessarily a must. Would you say that now travelers are really taking a big risk if they don't have it?
I would completely agree with that. Years ago, it kind of felt like an afterthought, an add-on almost that, wasn't necessary. But given the climate and the current travel conditions, not having travel insurance is a significant risk.
So let's go through what's covered and what's not, because I still feel like it's very opaque. I say this because I hear stories of someone who thought they were covered and then they were surprised that they weren't. Or when they go to claim, they're like, no, that's not our responsibility. That's someone else's responsibility. So when someone buys travel insurance, what is generally covered?
So that'll depend on the type of policy you buy. But say, for example, you buy a standard comprehensive travel insurance policy. So what you're looking for in that instance is you're looking to get trip cancellation. So that covers you up until your trip for the covered reasons. And then trip interruption, which would cover you after you've departed. So, for example, if any reason your trip was interrupted and you couldn't get to your hotel or your connecting flight, that's where trip interruption would come in. You have baggage delay or missing baggage coverage, and then medical emergency coverage. So that's really important, especially if you're traveling international, because your local, health insurance won't be there to cover you.
Okay, so let's play out a couple of scenarios, right? Because right now, huge lineups at the airport, and you hear that they recommend you have to be there 2 or 3 hours before. If you are, and you still miss your flight, and I feel like this is a gray area, Matt, would you still be covered?
Is. Unfortunately not.
Really?
Due to the long lines, your insurance company would say you should have came earlier. And, sometimes you can, sometimes you can't, depending on when your flight is. So, for example, if you're traveling internationally or having to go into the United States, you have to go through customs. Some airports, customs doesn't open until 5 a.m. You may have a 7 a.m. flight. It can be a little bit tricky if you can make it on time. I've seen long delays. I experienced them. I saw some people missing their flight. It was very unfortunate. What we can say is that 2 to 3 hour delay or 2 to 3 hour in advance of coming, maybe, give yourself a little extra time these days, especially traveling out of Pearson, just because of staffing being low. I know they're working their best to increase staff in the airport and trying to expedite that process, like removing the COVID rules, especially on coming back into the country, trying to make the airport flow a little bit quicker. But all I can say these days is just give yourself extra time. And unfortunately, travel insurance won't cover you for those increased delays in airport lines.
Okay, good to know. Another scenario, Matt, that I've seen is suppose you have a cruise or tour booked or even a connecting flight, right? And you miss these because the original flight was delayed or canceled. Would your insurance policy cover this? And ultimately, I guess, who's responsible here?
So in this scenario, this is where it would be important to have trip interruption insurance. So in this scenario, you're saying that you've gone in your first part, but you've been delayed whether to get to your cruise or to your second destination. It's a little bit murky whether your cruise line is going to support you there or the airline is going to support you. I think it would very much depend on who you're working with and their policies in place. The best course of action is to have a comprehensive travel insurance policy that includes trip interruption to cover you for any scenario, especially on a cruise, that if you're stuck or left behind because you've been late getting back to the boat or some other reason occurs, you're able to find accommodations to get back on the rest of your trip.
Okay, so just to be clear, you have travel insurance, but is it considered an add-on then?
To have trip interruption? I wouldn't say considered to be an add-on. It would be part of a comprehensive standard policy, but you can purchase, various parts of travel insurance independently. Like you could just purchase trip cancellation insurance,
Right.
or you could just purchase trip interruption insurance. It all depends on the carrier and what the packages they offer.
Okay, we're going to take a quick break and we'll continue this conversation. Stay with us. COVID-19 is still around and perhaps maybe not as top of mind as say last year. Is this something in your mind that people still need to get coverage for?
It's something that I would definitely look into when shopping for coverage to make sure that there isn't any exclusions. Uh, During the peak of the pandemic, a lot of people, when we reopened again, were trying to get out and travel. And what they weren't aware of is that some insurance policies, especially credit cards, weren't covering COVID 19 as an excuse for why you had to cancel your trip or your trip was interrupted. So even though it's less of a concern today in terms of our travel restrictions, I would still verify with the provider I'm with, whether it was a credit card, purchasing it through a service like Expedia, or buying a third party travel insurance policy. That'd be one of the questions I'd want to know is that, am I covered for COVID-19 cancellation or interruption?
Okay, I want to pick up on the credit card in a second, but one of the questions I did have
Yep.
for you, Matt, is look, Canada now has this air passenger protection regulation, right? So is this helping travelers in your mind, or are there still big gaps?
I would say everything helps in general, just every little bit of litigation.
Mm,
It's going to, trying to put the passenger first as much as possible. Um, but with any policy we see, there's always little gaps or niche scenarios that occur. So regardless of what the Protection Act's in place, I would still shop around and make sure that I have the coverage I need, and I would
yeah.
look through the policy I have and the Protection Act to make sure there isn't any gaps. Especially, everyone's travel can be unique. If you're doing a more advanced or long-term trip or something that's a little bit more adventurous, you probably need more coverage than somebody who's just traveling for the weekend to say New York or something like that.
Okay. So you said shop around. So let's talk about where people should buy travel insurance because,
Yep.
I mean, there's lots of places, right? If the
Yep.
default is to check or use your credit card, whatever that is, the travel
Mhm.
insurance and your credit card, what do people have to be aware of?
The limitations are the biggest thing with the travel insurance on credit cards. I mean, it's a nice option, especially if you're paying for a premium credit card. You're paying that annual fee. It's great to take advantage of that. Just keep in mind that generally you have to purchase the trip or the accompanying expenses with your card. So what I mean by that is, if you're booking a rental car, make sure you purchase that with your credit card for your rental car insurance to go in place. But there are limitations. You got to keep in mind that the card isn't customized for your trip. It's a general insurance policy that applies to everybody, and there are specific limits and exclusions that can make it a little bit, simplified. I guess I could say at best. So it's great for small trips. Anything longer and more adventurous, because say for example you want to go skiing in the Swiss Alps, they're not going to be covering you for that. There are even age restrictions too. So if you're someone who's over the age of 64, a lot of credit cards won't even cover you.
Yeah.
And then you got to also keep in mind that if you're traveling with your family, the credit card's covering you, not necessarily your family. So that's
Good
where you'd
point.
want to think about a more, comprehensive travel insurance policy. So for single trips, for somebody, like I said, doing a weekend trip, your credit card travel insurance is probably great for yourself. And you don't need to purchase anything additional. Anything a little bit more comprehensive, especially traveling into Europe and internationally, I would probably look elsewhere for a more comprehensive policy, or at least shop around to make sure I know apples to apples what I have and what I don't have.
Okay. We only have about a minute and a half till the end of our interview, but quick question on the travel sites because it's so easy to
Hmm.
add, the optional insurance without actually reading the fine print, and it's probably
For
because
sure.
you have some time pressure, right, to book the flight. What do you advise to people?
I wouldn't make a rash decision. If you
Yeah.
know you're booking a trip far in advance, do your research ahead of time. You can look into, say, Expedia's trip cancellation and travel insurance policies. They're listed on their site. Oftentimes, they will let you add it on later. Like I was reading again through Expedia, and you can go back in and edit your trip and add on the travel insurance.
Okay.
I mean, I just booked through an airline the other day. They continued to email me and asking me if I want to purchase travel insurance with them. So it's not necessarily has to be done in the moment. we do suggest that adding a travel insurance policy as soon as possible, especially for that cancellation part. You want to make sure you're covered, especially if your flight is, say, months later. It could be 6 months later. You want to make sure that if anything happens between now and that 6 months, you're canceled for those covered reasons.
Okay, and I would say other best practices we just put up a board is if you, in
Yeah.
case you do have to make a claim, take notes, right? Keep receipts.
Take take notes, keep receipts, have proper documentation.
Yeah,
I would be, if it's a trip interruption or trip cancellation issue, call within 24 hours.
yeah, timeliness.
Some
Yeah,
policies won't even cover if you're not calling you within 24 hours, and
yeah.
then medical emergencies within 48 hours.
All right, Matt, great to have you on. Thanks so much.
Appreciate it. Have a great day.
Welcome back to Strictly Money. Canada's top banking regulator has announced new rules are coming for certain real estate loans. This at a time when interest rates are rising, home prices are falling, and many Canadians are overextended in debt. To discuss this new guideline and the impact it could have on homeowners is David Larock. He's president of Integrated Mortgage Planners. David, great to have you back.
Thanks for having me.
So I should clarify these changes were announced by the Office of the Superintendent of Financial Institutions. So this is OSFI. Can you explain in your words what this covers, which loans it covers, and just maybe the high level changes? We have a board that we'll bring up.
Sure. There were two changes announced. The first is that OSFI is reducing the maximum loan to value on readvanceable mortgages from 80% down to 65%. And they're also capping the maximum loan to value on reverse mortgages at 65%.
Okay. So I guess the big question is this long overdue? I mean, should they have done this perhaps before we got into the situation that we're in now? And I should probably add that this doesn't take effect until the end of 2023.
That's right. The changes will be implemented on the fiscal year end of each at each lender's fiscal year end in 2023, and that would be either October or December of next year. As far as whether this was long overdue, that's open for debate. HELOCs worry our regulators because they allow borrowers to use the HELOCs to stay afloat if they run into financial difficulties. And a lot of people in my industry would argue that they've been very helpful in that sense. And in giving borrowers with a lot of equity in their homes access to ready funds, they've helped people in financial distress avoid getting into more serious distress. And because the default rates on HELOCs is about half of the default rate on mortgages, they've performed very well. So some would argue that they're doing their job and that maybe this change wasn't needed. Now, the regulator isn't talking about past tense. They're concerned about the future, and they see storm clouds on the horizon. And bankers, and I guess banking regulators, there's an old adage that they give you an umbrella when the sun is shining and then ask for it back as soon as it starts to rain. And OSFI sees storm clouds on the horizon with the economy slowing, house prices starting to fall, and they want to rein in their horns now in anticipation of what's to come. So I don't think personally that there was any urgency to do this sooner. I think the fact that they're delaying it gives the market time to absorb this news at a time when markets are already feeling a bit skittish and vulnerable. So overall, I think the timing was relatively prudent, and no, I wouldn't fault them for not having done this one sooner. Now, with reverse mortgages, they're interesting. For most of the time that reverse mortgages have been around in Canada, there's been only one provider called CHIP. And in the last little while, in the last year or two, there have been two competitors coming on the scene. These are very profitable mortgages. And CHIP had the playing field to itself. They were bought by the Ontario Teachers Plan. That gives you an idea of the long-term viability and the attractiveness of their business model. And not surprisingly, more competitors have entered the landscape. Now, when CHIP was running things by themselves, the maximum loan to value you could get was somewhere between 35 and 40%. And with the new competitors coming on the scene, they're pushing the envelope. They've driven down rates, which has been great for consumers, but they're also pushing loan to values up. So right now, I mean, you have to be, it's based on your age, and you have to be practically Methuselah, but the highest loan to value that you can get today would cap out at about 59%. And what OSFI has said is, we're going to put a cap going forward at 65. So lenders right now, you're maxing out at 59%. You can go up to 65%, but not above that. And again, this is a preemptive move to say, now that there's more competition in this space, we're going to put a cap on it that ensures there's a minimum equity buffer of 35%. And I think that is prudent because reverse mortgages don't have any payments associated with them. The payments are rolled onto the mortgage and they compound with the mortgage interest over time. So a healthy buffer in reverse mortgages is prudent.
Okay, great. I mean, I think that's really important too, to distinguish between, these rules and which one is going to have an impact more on others. So we'll continue this conversation. We're going to take a quick break. We'll be right back, David. Welcome back. David, we've been talking about these new mortgage rules that are coming. One of the questions I did have, though, is what happens to those people who are above that threshold, right? So they're bringing the maximum loan to value down from 80% to 65. So what happens to those people who are still above that?
Well, this change will technically affect 1 out of every 10 borrowers. That's how much. That's the impact that OSFI estimates. But that includes the unused portion of the home equity lines of credit, and on average, they have a utilization rate of about 28%. So the actual number of borrowers who are impacted will be lower. Basically, when your mortgage comes up for renewal after 2023, when the lender has announced the change, so we're still a year away. And it's only when the mortgage comes up for renewal. If you have a home equity line of credit with a balance that puts your loan to value above 65%, then you have to roll that balance into the mortgage. So you don't have to pay it back, but you can't keep it as a balance outstanding on the home equity line of credit. You need to roll it into the mortgage. And if you have an unused portion of your home equity line of credit that is above 65%, that unused limit will be cut back to 65%. So by and large, it shouldn't, I mean, you can still borrow the money, you just can't borrow it on the HELOC, or you lose your limit, which you weren't using anyway. So it shouldn't have a huge impact on the market.
Okay, thanks for that clarification, because I think some viewers will wonder how it impacts them. David, I read your blogs, and for viewers who are watching, I highly recommend they follow David because you have a wealth of information. One of the points that you made, and I think is a good one, is that OSFI has failed to address the most immediate risk in residential mortgages, and that's the stress test rules. Can you explain this?
Sure. So the way the stress test works, you are qualified at the greater of the stress test rate, which today is 5.25%, or the rate on your mortgage plus 2%. So if you have a variable rate mortgage today, chances are it's around 3%, in the low 3% range. And that means the odds are that you're being qualified at the stress test rate of 5.25. But if you want a fixed rate today, let's say you're a conservative borrower and you want to play it safe, and even though fixed rates have spiked a lot, you want to lock in. Fixed rates today are north of 5%. So most of them anyway. So if you want a fixed rate, you're not qualified at 5.25 like you would be if you were a variable rate borrower. You're qualified at your contract rate plus 2%, which pushes you up into the 7% range for fixed rate borrowers. That can impact affordability by up to 20%. And basically what that means is if you're a stretched borrower who's trying to borrow the maximum that you can qualify for, you can qualify for more if you take a variable rate than a fixed rate. Now, I'm a proponent of variable rates. I think they make sense for a lot of people, but they certainly don't make sense for everybody. And if I had to isolate one subset of borrowers who were better suited for fixed rates, they would be borrowers who are borrowing up to the maximum of what they can qualify for. Right now, the way the stress test works, OSFI and lenders are funneling those borrowers into variable rate mortgages. I've had conversations with people and I've said, if you want a fixed rate mortgage, you can qualify for X, but if you want a variable rate mortgage, you can qualify for Y. And if a borrower is stretched, they really have no choice other than going with a subprime rate, which is much more expensive.
Right.
So the way the stress test is set up today, fixed rates are much harder to qualify than variable rates. That should never be the case. The conservative choice should never be harder to qualify for. They should be equal, or variable rates could the qualifying rate for variable rates in some scenarios could potentially even be a little bit higher. But by and large, right now, the big risk that the residential market in Canada is facing is we're funneling borrowers into variable rates. In some cases, borrowers who are ill-suited to that option. OSFI knows this, and they did nothing to address it in their latest announcement, and they should be criticized for that.
Okay. We only have about 30 seconds until the end of this interview. How are you reading the housing market right now? Are you seeing it turn into a buyer's market, and do you see more downside?
I think it's a balanced market right now. Sellers are sticky on the way down. They're reluctant to drop prices. They don't want to accept that prices have peaked. And buyers are cautious now. They don't have the same urgency to jump into the market because the cost of waiting isn't higher prices at this point, or at least they don't think so. And with more rate hikes on the horizon from the Bank of Canada, a lot of buyers are saying, let me see how the market absorbs all this, and then I'll reevaluate at that time.
All right, David, appreciate you coming on. Thanks.
Thanks, Saijal.
David Larock of Integrated Mortgage Planners. Well, that wraps up this show. To catch previous episodes, head over to the newsforum.ca or follow the Newsforum on YouTube. Thanks for watching. Until next time, stay well, stay wise, and stay wealthy.